Imagine a time long ago, around 2000 BCE. The world was a very different place, a tapestry of emerging civilizations and bustling communities. The air was filled with the sounds of life, from the clamor of marketplaces to the solemn chants of temple priests. This was an era where human ingenuity began to take shape in ways that would profoundly influence the future. The vast landscapes were dotted with burgeoning cities and villages, each with its own unique culture and way of life. These early societies were laying the groundwork for what would become some of the most influential civilizations in history. Grand civilizations were emerging in Mesopotamia and Egypt. These regions, often referred to as the cradle of civilization, were home to some of the earliest forms of organized society. The Mesopotamians, with their intricate irrigation systems and ziggurats, and the Egyptians, with their monumental pyramids and sophisticated hieroglyphics, were pioneers in many fields. As these societies grew, so did their need to manage resources and wealth. Trade became a vital part of daily life, with bustling markets where merchants exchanged goods ranging from grains and spices to textiles and precious metals. The complexity of these transactions required innovative solutions. This is where temples played a surprising role. Far from being mere places of worship, temples became central to the economic life of these civilizations. They were not just spiritual sanctuaries but also hubs of financial activity. Temples became the first banks. People would come to these sacred places not only to offer prayers, but also to deposit their valuables. The priests, seen as wise and trustworthy, were entrusted with the safekeeping of these goods. Temples were not just places of worship, they were centers of economic activity. People trusted the temples because the priests were seen as wise and honest. This trust was the cornerstone of the early banking system. The temple's role extended beyond mere storage. They facilitated trade and commerce, acting as intermediaries in transactions. This made them indispensable to the economic fabric of the society. Priests were seen as wise and honest. Their reputation for integrity made them ideal custodians of wealth. This trust was crucial in a time when formalized banking systems were non-existent. This made temples the perfect place to store valuables. People deposited gold, silver, and even grain. These deposits were the beginnings of a banking system. People deposited gold, silver, and even grain. These deposits were the beginnings of a banking system. The temples kept meticulous records of these deposits, ensuring that everything was accounted for. These deposits were the beginnings of a banking system. The priests maintained detailed ledgers, recording every transaction with precision. This level of organization was unprecedented and laid the groundwork for future financial systems. The temples did more than just store wealth. They also managed it. The priests would loan out deposited goods, acting as early bankers. This system allowed for the redistribution of resources within the community. They loaned out deposited goods. This helped people in times of need. Farmers could borrow grain for planting and traders could borrow capital for their journeys. This system of loans was crucial for the economic stability of the community. This helped people in times of need. Farmers could borrow grain for planting. This ensured that they could continue to cultivate their lands and provide food for the community. Farmers could borrow grain for planting. This was a lifeline for many, ensuring that they could sustain their livelihoods and contribute to the community's food supply. Traders could borrow capital for their journeys. This enabled them to embark on trading expeditions, bringing back goods and wealth that benefited the entire community. The temples thus played a pivotal role in fostering trade and economic growth. These early financial activities laid the foundation for modern banking. The principles of trust, record-keeping, and resource management established by these ancient temples are still relevant today. This fascinating system, born out of necessity and trust, reveals the ingenuity of our ancestors. They found innovative solutions to manage resources and foster economic growth, leaving a legacy that continues to shape our world today. They found solutions to manage resources and foster economic growth, leaving a legacy that continues to shape our world today. The ingenuity and foresight of these early civilizations laid the groundwork for the complex financial systems we rely on in the modern world. The legacy of these ancient banking systems is evident in the financial institutions we see today. From the trust placed in banks to the meticulous record-keeping and resource management, the influence of these early systems is undeniable. They were the pioneers of an idea that has become a cornerstone of modern society. Priests held a unique position in ancient societies. They were not just spiritual leaders but also key figures in the administration and daily life of their communities. Their influence extended far beyond the religious sphere, touching upon various aspects of governance, education, and even economics. They were respected figures of authority. Their wisdom and knowledge were sought after, and their decisions were rarely questioned. This respect and trust made them central to the functioning of ancient societies. People turned to them for guidance on a wide range of issues, from personal dilemmas to community disputes. The priests' role as mediators and advisors was crucial in maintaining social harmony and order. This made them ideal custodians of wealth. Their integrity and the sacred nature of their position meant that people felt confident in trusting their valuables to the priests. They became the first bankers, managing the wealth of the community with a sense of duty and responsibility. This early form of banking was essential for the economic stability of ancient societies. Temples, with their imposing structures, provided a sense of security. These grand edifices were not just places of worship, but also served as safe havens for the community's wealth. People felt safe depositing their valuables within their sacred walls. The sanctity of the temple and the reverence for the priests ensured that these deposits were well protected. Gold, silver, precious stones. These were entrusted to the priests. The wealth accumulated in the temples was a testament to the trust the community placed in their religious leaders. The priests kept meticulous records. They documented every transaction with great care, ensuring that there was a clear and accurate account of all deposits and withdrawals. They developed systems to track deposits and withdrawals. These early accounting methods were sophisticated for their time and laid the foundation for modern financial record-keeping. The role of the priests extended beyond safeguarding possessions. They became lenders, providing loans to those in need. This practice was crucial in supporting the economic activities of the community. Farmers, facing a lean season, could borrow grain. This support was vital for their survival, and ensured that they could continue to cultivate their lands and provide for their families. Traders embarking on long journeys could borrow capital. These loans enabled them to purchase goods and embark on trading expeditions, which were essential for the flow of goods and wealth. These loans, often granted with interest, stimulated economic activity. The interest charged on loans provided a return on the wealth managed by the priests, further enhancing the temple's resources. The priests, through their careful management of resources, played a crucial role in the growth of ancient economies. Their financial acumen and ethical stewardship ensured that the community's wealth was used effectively. Their actions laid the groundwork for the complex financial systems we have today. The principles of trust, record-keeping, and resource management established by these early bankers continue to underpin modern banking practices. In early societies, people relied on a simple system of exchange barter. This system was based on the direct trade of goods and services. If you needed something, you traded something you had. For example, a farmer might exchange grain for tools from a blacksmith. This method of trade was straightforward and easy to understand. However, bartering had its limitations. Finding someone with what you needed and who also wanted what you had was challenging. This double coincidence of wants could be difficult to achieve. Additionally, not all goods were easily divisible. How do you trade a cow for a handful of grain? The limitations of barter became increasingly apparent as societies grew more complex. A new system was needed, one that was more efficient and flexible. This led to the development of money. Money acted as a medium of exchange. It had an agreed-upon value. This simplified trade and laid the groundwork for more sophisticated economic interactions. Barter was the earliest form of trade, and it worked well in small, simple communities. People would trade items they had in surplus for items they needed. This system was based on mutual need and trust. However, as communities grew larger and more complex, the limitations of barter became more evident. The need for a more efficient system of trade became apparent. Imagine a farmer who has a surplus of grain but needs a new plow. He would have to find a blacksmith who not only has a plow to trade but also needs grain. This could be a time-consuming and frustrating process. The farmer might have to travel long distances and negotiate with multiple people before finding a suitable trade. The inefficiency of barter became even more pronounced as societies grew and trade networks expanded. People needed a more reliable and efficient way to conduct transactions. The limitations of barter were holding back economic growth and development. The double coincidence of wants was a major obstacle. It was not always easy to find someone who had what you needed and wanted what you had. This made trade difficult and time-consuming. People needed a more flexible and efficient system. Another limitation of barter was the indivisibility of certain goods. Large items like livestock or pottery could not be easily divided into smaller units for trade. This made it difficult to conduct transactions involving items of different sizes and values. For example, if a farmer wanted to trade a cow for a small amount of grain, it would be nearly impossible to divide the cow into smaller units. This made barter impractical for many types of transactions. The need for a more efficient and flexible system of trade became increasingly apparent. People needed a way to conduct transactions that did not rely on the double coincidence of wants or the divisibility of goods. As societies grew more complex, the limitations of barter became more pronounced. People needed a more efficient and flexible system of trade. This led to the development of money. Money acted as a medium of exchange. It had an agreed-upon value, which made trade more efficient and flexible. People could now conduct transactions without the need for a double coincidence of wants. The development of money revolutionized trade and commerce. It allowed for more complex and sophisticated economic interactions. People could now save and invest their wealth, leading to economic growth and development. Money also facilitated the development of markets and trade networks. People could now buy and sell goods and services more easily and efficiently. This led to the growth of cities and the development of more complex economies. The agreed-upon value of money made trade more predictable and reliable. People could now conduct transactions with confidence, knowing that the value of money was stable and widely accepted. The development of money was a major milestone in the history of human civilization. It laid the groundwork for the development of more complex and sophisticated economic systems. Money made trade more efficient and flexible, leading to economic growth and development. As agriculture developed, people began producing more food than they needed immediately. This surplus needed proper storage. Early farmers dug pits to protect their grain from the elements, pests, and other threats. These pits were the precursors to more advanced granaries. Temples, with their resources and organization, played a key role in developing larger and more efficient storage solutions. They constructed vast granaries to house surplus grain and ensure its safety. These granaries served a vital function in society. They ensured food security during times of drought, famine, or other crises. Temples also housed secure vaults for added protection. These strong rooms protected valuable metals, precious stones, and important documents from theft. The thick walls and watchful guards provided peace of mind to depositors and ensured security. These vaults were the forerunners of modern bank vaults, setting the stage for future developments. These early storage solutions, born out of necessity, demonstrated the growing need for secure and organized systems to manage surplus and wealth effectively.